Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today we're diving into a report from the Federal Home Loan Bank of San Francisco, and trust me, it's more exciting than it sounds, especially if you're into deciphering financial puzzles. Let's just say we'll be looking at how they're borrowing and lending money, and whether it's a house of cards or a solid foundation. This report is a Form 8K, a snapshot of important events that the Federal Home Loan Bank of San Francisco wants to share with investors dating back to March of 2025. These reports are like financial breadcrumbs, giving us clues about what's happening behind the scenes at the bank. The core of this report revolves around something called direct financial obligations. In plain language, this is about how the bank is borrowing money by selling debt securities. Think of it like taking out a loan, but instead of going to a traditional bank, they're selling bonds to investors in the capital markets. These debt securities are known as consolidated obligations, which come in the form of bonds and discount notes. Here's the catch. These aren't just the responsibility of the Federal Home Loan Bank of San Francisco alone. They are actually the joint responsibility of all 11 federal home loan banks. So if one bank struggles, the others might have to chip in. It's like a financial safety net, but also a potential risk. Now, there's a regulator overseeing all of this, the Federal Housing Finance Agency. They have the power to make any of the federal home loan banks pay up if another bank can't cover its debts on these consolidated obligations. This means that even if the San Francisco bank is doing well, it could be on the hook for problems at another federal home loan bank. This report also includes Schedule A, which lists all the bonds and discount notes that the federal home loan banks, with the San Francisco Bank as the main borrower, have committed to issue. It's basically a list of their upcoming borrowing activity. The report states that issuing these consolidated obligations is important to the bank, but they aren't saying that any specific bond or obligation is necessarily crucial on its own. In other words, they're issuing a lot of debt, but no single piece of debt is a make or break deal. It's important to note that Schedule A doesn't tell the whole story. It doesn't include information about interest rate exchange agreements or other financial tools they might be using to manage their risks. These agreements, called derivatives, can change the actual cost of borrowing, so what you see in Schedule A might not be the full picture. Also, Schedule A doesn't show you the total amount of debt the bank owes at any given time. It only shows new issuances. To get the full debt picture, you'd have to look at their regular financial reports filed with the SEC. The dollar amounts listed in Schedule A are the face value of the bonds, not necessarily what the bank actually receives after discounts or pays back after premiums. The real cost of borrowing can be a bit different. Let's dive into Schedule A and see what kind of borrowing the Federal Home Loan Bank of San Francisco is up to. Remember, these are just some highlights and the full picture is more complex. We see several entries from the beginning of March 2025 detailing different bonds issued by the bank. Each entry includes a trade date, a unique identifier called a CUSIP, settlement date, maturity date, and a coupon percentage. For example, on March 5, 2025, they traded a bond with a maturity date in April of 2026, a little over a year later. The coupon percentage or interest rate is 4.37%, and the par value or face value is $150 million. This bond can be called back early with optional principal redemption and follows what's called a Bermudan call style, redeemable on specified recurring dates. Also, on March 5th, they traded another bond for a smaller amount of $15 million with a maturity date far out in 2030. This bond also has optional principal redemption but follows a European call style, meaning it's redeemable on a particular date only. Then on March 6th, they traded a bond with a 9/07/2029 maturity, a 4.2% coupon, with optional principal redemption following a European call style. Let's quickly decipher some of the terms used in the descriptions, like optional principal redemption. This simply means that the bank has the option to pay off the bond early before the maturity date. It's like having a call option on their own debt. The call style tells you when they can do this. Bermudan means they can call the bond back on specific dates, while European means they can only call it back on one particular date. The report also mentions rate type, which tells you whether the interest rate on the bond is fixed, variable, or changes over time. In most of these cases, it's fixed constant, meaning it's a fixed rate. So what does all of this tell us? The Federal Home Loan Bank of San Francisco is actively borrowing money through these consolidated obligations. They're using a mix of short-term and longer-term bonds with different interest rates and call features. Now for my take on this situation. The Federal Home Loan Bank of San Francisco seems to be playing a careful game of borrowing and lending. They're tapping into the debt markets to fund their operations, which, in turn, supports the housing market. It's a crucial role they play. One of the strengths is their access to capital. Being part of the Federal Home Loan Bank system gives them a certain level of stability and credibility. Investors are generally more willing to lend money to an institution backed by the government, even if indirectly. However, there are also risks. The fact that all 11 federal home loan banks are jointly responsible for these consolidated obligations means that problems at one bank could quickly spread to the others. It's a bit like a chain reaction. If one bank makes poor lending decisions or faces financial difficulties, the others could be on the hook. Another thing to keep an eye on is their use of interest rate exchange agreements. While these derivatives can help them manage their risks, they can also add complexity and potential for unexpected losses if not managed carefully. It's like adding extra gears to a machine. It can make it run more efficiently, or it can break down more easily. Overall, the Federal Home Loan Bank of San Francisco appears to be in a reasonably stable position, but they're operating in a complex and interconnected financial system. It's important for them to manage their risks carefully and for investors to keep a close watch on the entire Federal Home Loan Bank system. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, give us a like, drop a comment, and subscribe for more insights into the world of corporate filings. Until next time, keep decoding.